History doesn't knock on the door. It kicks it down. And when it comes to the stock market, history has a nasty habit of repeating itself, especially when investors are the most confident. Every bubble starts the same way. Not with panic, not with fear, but with a sentence that sounds smart and ruins portfolios. This time is different. Sir John Templeton, one of the greatest investors of all time, a man who averaged 15% annual returns for nearly 4 decades, called those the 4 most expensive words in the English language. And he wasn't being dramatic. Because nothing empties a brokerage account faster than blind optimism dressed up as intelligence. So let me ask you something before we go any further. What if the biggest risk in today's stock market isn't a recession, but confidence itself? Stick with me because the story I'm about to tell you doesn't start in Silicon Valley. It started over 50 years ago. And it ends suspiciously close to where we are right now. If you find value in this kind of real market history, hit the like button. It tells YouTube this isn't just another hype video. There's a man every serious investor eventually runs into, at least philosophically. Jesse Livermore. A legendary trader, a market pioneer. The inspiration behind reminiscences of a stock operator. Livermore made and lost fortunes by understanding one simple truth. There is nothing new on Wall Street, whatever happens has happened before and will happen again. And there's a stock market bubble Livermore would immediately recognize today. One almost nobody talks about anymore. A bubble that didn't involve crypto, didn't involve dot-com startups. Didn't involve subprime mortgages, it involved great companies. The kind of companies everyone agreed were untouchable. It was called the Nifty 50. The story begins in the late 1960s. America was riding high. World War II was behind it, factories were booming. Suburbs were exploding, the middle class was growing. The U.S. had landed a man on the moon, allegedly, and life felt unstoppable. People weren't just optimistic, they were confident. And the stock market reflected that. From 1945 to 1970, U.S. stocks rose more than 350%. A generation of investors grew up believing stocks only went in one direction. Out of this optimism came a new investing philosophy. It sounded logical, it sounded safe. And it turned out to be extremely dangerous. It was called one-decision investing. The idea was simple. Buy companies so dominant, so powerful, so essential to everyday life, that you'd never need to sell them. Ever, these companies became known as the Nifty 50. We're talking about household names. Coca-Cola, McDonald's, American Express, Xerox, Polaroid. Not risky startups. Not speculative plays. Blue chip royalty. Selling them wasn't just considered unnecessary. It was considered stupid. And that's when the math stopped mattering. Here's a rule you should tattoo on your brain as an investor. If something is sold as having no downside, it usually has the most. By the early 1970s, the overall stock market traded at a reasonable PE of about 15. The Nifty 50. They lived in a different universe. Coca-Cola traded at 46 times earnings. Xerox at 49. McDonald's at 86. Polaroid at 90. On average, these stocks traded at 42 times earnings. But it gets worse. At their peak, the Nifty 50 made up nearly 45% of the entire U.S. stock market. Let that sink in. Almost half the market was resting on the assumption that these companies would grow forever, without interruption at any price. Sound familiar? Before we jump to today, let's finish the story. Because reality always shows up eventually. Between 1973 and 1974, everything broke. Oil prices quadrupled. Inflation surged from 3% to over 11%. Unemployment doubled. And President Nixon permanently ended the gold standard. The market didn't correct. It collapsed. Stocks fell nearly 50%, the worst bear market since the Great Depression. And the so-called can't-fail stocks. They failed spectacularly. Coca-Cola fell over 60%. McDonald's dropped more than 70%. Polaroid collapsed over 90%. These weren't bad companies. They were overpriced expectations. And here's the part most people forget. This wasn't a quick recovery. It took 8 years until 1981 for the market to simply get back to where it started. 8 years of dead money. 8 years of patience being tested. Now pause here. Ask yourself, could you sit through 8 years of zero returns while inflation eats away your purchasing power? Because that's the price of buying perfection. Now let's talk about today. Mark Twain famously said, "History doesn't repeat itself, but it rhymes." And right now, the rhyme is getting loud. In 1972, the Nifty 50 made up about 45% of the market. Today, 7 companies make up roughly 36% of the S&P 500. The Magnificent Seven: Microsoft, Apple, Google, Amazon, Meta, Tesla, Nvidia. 7 stocks carrying an entire market. Yes, they're innovative. Yes, they dominate. Yes, they print cash. But so did Xerox. So did Polaroid. So did Avon. Great companies don't guarantee great investments, especially at the wrong price. And the valuations. Let's be honest. Google and Meta trade around 28 times earnings. Amazon around 35. Apple near 37. Microsoft around 38. Nvidia is near 50. Tesla well triple digits. Are these bad businesses? Absolutely not. Are they priced as if nothing can ever go wrong? That's the real question. Drop your thoughts in the comments. Do you think these valuations are justified, or are we repeating the same mistake with better marketing? Now here, where I differ from most fear-based videos. This is not 1972. Today's companies are global. Margins are higher. Technology scales faster. AI is real productivity, not just hype. So yes, the bullish case exists. But here what hasn't changed. Human behavior. Overconfidence. Concentration risk. And the belief that price no longer matters. Bubbles don't pop because companies are bad. They pop because expectations become impossible to meet. All it takes is a few dominoes. Higher rates for longer. Slower earnings growth. Regulation. Geopolitical shocks. Liquidity tightening. You don't need all of them. Just a couple. So what's an investor supposed to do? This is where most videos end. With fear. Let's do better. First, diversification still matters, even inside index investing. Second, valuation matters more when concentration is high. Third, you don't need to predict the crash to survive it. Historically, investors who survived periods like the 1970s didn't chase the hottest stocks. They focused on cash flow, dividends, reasonable prices, and patience. Not timing the top. Managing risk. That's the difference between speculation and investing. If this perspective is helpful, subscribe. This channel is about thinking clearly when markets stop making sense. Warren Buffett said it best. What we learn from history is that people don't learn from history. Today's market isn't guaranteed to crash tomorrow. But it is priced for perfection. And perfection has a terrible track record. So the real question is, will the market crash? It's this. Are you prepared if it doesn't reward optimism anymore? Let me know your thoughts below. Are we in a modern Nifty 50 moment? Or is this time truly different? History is watching.